Okay, we're going to go ahead and start with just the refresher on how we started off with the principles of accounting itself. So we're going to start with, go ahead and go to the principles of accounting equation, which is going to be assets equals liabilities plus owner's equity. Now I'm going to break it down to you so you can understand each term to understand exactly what they mean. So assets is going to be what you own in the business. So that could be anything. It could be computer equipment, desks, backpacks, computers, anything that you really need that you use for your business to make it function. And the debits and credits will always be this way for the asset side, where it'll be debit increasing and credits will be decreasing. And one thing to note is that any normal balance for all your equations, all your T accounts, will be the increased side. So I'm going to say that again. The normal balance will be the increased side for any accounts. Morning. Go ahead and change it to the liabilities one. Now, liability is going to be what you owe in the business. You, the business owner, probably don't have enough money to invest into more equipment. So what you would do is you would probably go to the bank, ask for about $3,000, and you would use that to invest more into your business. So that's just what you're going to owe. So since you have assets that you own, liability is going to be the exact opposite of what you owe. So the debits and credits on the T account will be the exact opposite, where credits will increase and debits will decrease. And now to the owner's equity. The owner's equity is going to be the value of what you own after any liabilities have been paid off. Now the one thing is with the T accounts and the owner's equity is that it's going to have both versions of the T account, where debits will increase and also credit will increase on both sides. I'll get to that in a little more in the next couple of slides. Now, the one things that I want you to note is that for every transaction that you run into is that you'll always record the debit first and then the credit second. There will always be at least two accounts that will be affected wherever they are in the equation. Okay? And the other thing that I have to add in is that for all the equations, all the T accounts, debit will always be the left side, credits will always be the right side, regardless. Okay? So the only thing that will change between each account is which side increases and which side decreases. Yes. Now the terms to know, like just to get into specifics of what are in the assets, the one that I saw the most that y'all were kind of getting mixed up on was accounts receivable. And accounts receivable is when you have a transaction that your customer owes you money for the services that you did for them or the products that you sold them. So when you have that accounts receivable, that means that you still need to receive money from your customers. They haven't paid you yet. But it's going to be the same way. Go ahead and click it one more time. It's going to be the same. It's going to be the same debits and credits, where debit will increase and credit will decrease because it's an asset. Always remember the asset account will have the debit increase and the credit to decrease. Now the other one that I saw y'all getting mixed up within the accounts receivable was accounts payable, which is a liability account. And now the liability account is what you, the business owner, owe to somebody. That could be the bank, maybe to another person that you're working with, a vendor, a supplier. And now this is where you, the business owner, are buying stuff on credit or without paying in cash right away. And this is where I saw you all getting pretty mixed up with those two, accounts receivable and accounts payable, because you're both seeing the on account in the transactions. So one thing to note is for accounts receivable, if you see customers bought stuff from you on account, then you would know that the customer owes you money. Now, if the transaction just says that you bought equipment on account or bought supplies on account, that means you, the business owner, bought something that you owe. Go ahead and go to the next slide, please. And now for the owner's equity, this is where I'm going to get into the information of where both T accounts show in. Now expenses it's fine. Expenses show that expenses will be where the money that you pay that's business related, any bills that are for the business, which would be the rent, any office supplies expense, that'll come in later. And then there'll be salaries expense, any expenses that relate with the business will show as an expense account. Will be recorded in the expense account. And now the expense account and withdrawals, which is money that will be taken out for personal use, is withdrawals. Let me just clear that up. Withdrawals is money that you're using for personal use that's not company related. And both of these accounts show money leaving the business. So when money's leaving the business in the owner's equity side, it's going to be debits increase and credit decrease. Okay, so that's going to be the one pair that shows that T account for debits increase, credit decrease. And the other two, bless you, the other two terms that you need to know that will show the opposite version, which shows credit increase, debit decrease, will be capital and revenue. Now, capital will always be the initial investment or the new value of the business every month. So every time you see that the business owner invested money in a transaction, you would automatically know that it's going to be capital that you're going to be using. And for revenue is money that you've earned by either selling a product or doing a service for your customers. So every time you see a transaction with money either money coming to you right away or having to be paid later, you would still record it under revenue. Does that make sense? And that's going to show, these two accounts, capital and revenue, will show credit increasing, debit decrease. Make any sense? Yes? You can go to the next slide, please. And now we're going to go do some examples on accounts receivable. Now, accounts receivable shows, well, the book will always show you that it would say prepared desserts, or it would say anything prepared for you on account for a customer. So if you see prepared for a customer on account, you would automatically know that you have to record one account as accounts receivable, and the other one would be the revenue. Now, hold it right there. Which side would be the debit side here? If I may quiz y'all real quick. Why the revenue? Well, you're right with the increasing of the account. However, what's the normal balance for the revenue T account? Which side increases for the revenue side? No, it would be the credit side for the revenue. For accounts receivable, since it's an asset account, it would show that debit would increase, credit would decrease. Okay? So does this kind of make sense right here? That every time you see a prepared desserts for customers on account, you would automatically know that since you prepared for a customer on account, you've done a service for somebody. So that's one account, that's revenue. The other account would be on accounts receivable because you've done a service on account. They haven't paid you yet.
So both sides?
Both sides will increase, yes. Yes. Because you've done a service, but yet even though they haven't paid you yet, you still have to record that they owe you that amount of money for that service that you did. Does that clarify more? No questions so far? Go ahead and go to the next one. Now, the accounts payable will usually show just a very vague statement that says it'll say bought equipment on account for whatever amount that you have. So when you buy equipment on account, what are the two accounts that you think of? Yes, accounts payable is one, and the other one is that would be a debit or credit. Okay. Yes. And the equipment would be the other one, right? Which would be your debit.
Yeah.
Yes, because you invested in equipment, but not with your money, right?
Yeah.
Mm-hmm. And I believe the next transaction will be one where you actually shows a payment of what you owe to somebody. So this partial payment for $200 for transaction B was bought equipment on account for $600. So what you would do is you would decrease your accounts payable, what you increased before. So you would debit your accounts payable by by the amount said, which is $200, and you'd also decrease your cash because you're paying off what you owed before. Go ahead and go to the next slide, please. And now for the expenses. Remember that expenses are for business-related transactions. Anything that has to deal with the business. So when you have the telephone bill to be paid for $120, you're gonna have to record that first. Telephone expense debited $120 because you're showing that you're gonna use $120 to pay that bill. And then your credit would be to decrease $120 because you're going to actually pay that off that day for $120. Now this is another transaction that shows that you received a bill that's company related, but you're not going to pay it right away. So the way you would have this recorded is you would record the rent expense debited first, because that's your debit. You have to record your expenses, your debits first, which will be your rent expense. And since you're not paying it right away, you're gonna have to show that in your accounts payable to what you owe to that company. So does that clarify anything that's up in the air? Yes? Now for the owner's equity side, that shows company related transactions, that shows money leaving, would be the withdrawals. Now withdrawals showing that Dr. Claus paying her personal company bill, telephone bill, with her company checkbook. This is how the book will usually tell you the transaction. It'll always tell you that it's either from the company checkbook or it'll say withdrew. The business owner withdrew money. So that's just a dead giveaway sometimes. Sometimes they'll just be a little bit tricky and they'll just tell you, like it says here for transaction F. And you would record your withdrawal first because that's money leaving the business, and then you would show that your money would decrease because you're withdrawing that amount of money. Exactly, because you're taking that amount of money out of your business and you're going to use that for your own hearsay, whatever you want. And now for the capital. Capital is going to show always, like I said, initial investments or the next amount, the next value from the end of the month to the next month. And generally they're going to show you the initial investment in any transaction in the book. They're going to show you that it's going to be initially invested this amount of money into the business. And you would debit that amount for whatever it is, or whatever it's going to be cash, $1,400 in cash, $1,300 in equipment, whatever it is, you're going to debit that first, and then you would credit or increase your capital. So again, it would be cash to be increased or debited first to whatever value, which is $1,400 in this case, and then you would credit your $1,400 for your capital. And that'll show the balances on each side of the equation. Yes, you would, but it's going to be very rare. The only time you would decrease your capital would be if you're having a net loss from your calculations at the end of the month, or if you're liquidating just to go out of business. Yeah, so that's worst case scenario if your capital to decrease. And our final transaction will be revenue. So it's received cash for making delivery for tamales for $140, right? So when you're doing a service for somebody, they already paid you right off the bat for this case because they said that you received cash for making and delivering the tamales. So you're going to have to show that the cash increased, or debited for the $140, and then your revenue would be recorded as $140 as well. And that balances out both sides of the equation. So if anything that you need to remember is that there's always going to be a debit and a credit for each side of a transaction. Next slide, please. And then this was just a test. So Dr. Claus invested $1,400 in cash into her business. What are my two accounts? Cash and capital. Now which one will increase? Which one will be debited? Yeah, that's the end of it.